Calculating your correct lot size within inside of any trading instrument in the financial markets. This is something that newbies consistently ask, and that even things that people that have been in the market a long time, experienced traders, often get wrong, in my opinion. What I'm meaning by this is that your lot size, if calculated incorrectly, can lead to either one of two things: returns, which are far larger or far smaller than that is comparable to your account value size, or losses that far exceed your account value's risk tolerances, or are simply way too small that then the impact is so tiny that you're never going to see an actual substantial growth to reach your targets, especially with inside of a prop firm. So to get this started off, on your watch list on TradingView, if you do not use TradingView, if you're a brand new beginner, this is a platform I highly recommend. You will see on the far right that you've got the percentage change. This is the percent change of the market inside of each day. Now, where do these values come from? Well, they come from the instrument that is being traded. As we can see, the NAS is at 0.33% for the day. And as we can see, other gold is up by 0.17%. So how I like to think about the market and what has served me well over the years is risking 1% of my account value per 1% of the market's movements. So here we are in the NAS. This is very simple to do. You're going to go to your left-hand side. It may be somewhere else, but you want to find where your toolbar is. And inside of the projection tab, you're going to go down to the measurer. And we're going to use the price range. It doesn't matter where you put the first part of the price range, but in the middle of this price range, you can see that there is a percentage change. We are going to move that percentage change to 1%, as you can see here. Then what we are going to do is we are going to use a horizontal ray, which is inside of your lines tool, and we're going to place the line on the top of the price range. We are then going to place one on the bottom of the price range. We are then going to double tap the horizontal ray at the top of the price range. It will most likely open on the style tab. You're going to go to coordinates. You're going to see where the coordinate is in the price. You're going to copy that. You are then going to go to a profit calculator. There are all kinds of profit calculators that have all kinds of instruments on them. So you can choose whatever one you want. The one that I'm using is from cashbackforex.com, and the instrument is called the US Tech because that's what we're on as a NAS 100, is US Tech 100. The deposit currency again is in US dollar. I am from England, however I trade FTMO accounts, and due to just the capital sizing that they have, it's 70,000 GBP or $100,000, and my brain just finds it a lot easier to calculate with $100,000. So that's why it's in dollar. You can change yours to yours if you wish. And what we're going to do is inside of this open price, we are going to paste that value, this top value. Then we are going to double tap the bottom and we are going to do the same. So obviously style, coordinates, price bar, right click, copy. Then we're going to place that in the closing price. We're then going to calculate that. So as you can see, this distance of 1% of this market move using one unit, so one lot, will lose or make $179.16. Now, on a £100,000 account, obviously, we want to be risking 1%, which is $1,000. So we are simply going to change this. And so if we move it to 3, you can see that we're getting closer. So if we move it to maybe 6, you can see that it's just over. So let's drop that to 5. You can see that it's under. So let's try 5.5. We're getting closer. What about another half? We can see we're getting even closer. So say we just do it at 6. Let's go 8. Oh, 9. That's good enough for me. So we now know that every single percentage move in the market will be losing 1% or making 1% of our actual capital allowance. So with inside of here now, we know that we should be using on a £100,000 account or $100,000 account on the US Techs on the NAS 100, we should be using 5.59 lots. So what you want to do is either save this or write this down, and that is the lot size that you should be using. Now I'm going to show you quickly how I use it. So if we go to the beginning of this month, we're in February of 24. So if we go to the 1st of February, and I'm just we'll do a video onto exactly my strategy in of itself, but that'll be in another video because I'd like to go into it with a lot of depth. But I'm just going to simply mark out where my entries would have been. So one entry would have been here, and we would have been holding it and trailing. And if I try to find where I would have been trailing to, would have been trailing to here, and then we would have had a sell position come in that would have been trailing pretty much the whole way through here. We can see that that would have been a loss. We can see now that a buy would have come in, and I would have been trailing. Let's give myself some room. I always do this. It's just better overall for consistency. So I'll try to do this fast. I'm going to buy here. Unfortunately got stopped out on this next run. So let's drew that red. Let's get a buy in there. Again, this market would have fallen much lower, but I always wait for a test to come back up. And then we would have sold. So let's make this one blue because we can already see this is going to be a profit trade, which it was. Let's just move it up higher than what it was. Then our stop loss would have been, just to give ourselves that little bit of edge, just a bit of breathing room to see if there is actually edge within inside the system. We're then going to trail again, and that would have been the buy, and then obviously so on, so on. As we can see within inside of this market, on our first trade of this month, we would have made 1.87%. We would have then lost, so let's bring up a calculator quickly. So 1.87% minus 0.5% plus 1.42% plus 0.85%, which was this trade here, plus 0.17% minus 0.49% minus 0.31% plus 1.68% plus 2.31%. So we can see that this month so far would have made us 7% gain. So let's just put plus 7% overall for this market. And the maximum drawdown that we would have had inside of here is right within these parameters here. So if we just quickly work this out, we go minus 0.49 minus 0.31. We would have had a max drawdown inside of our account value of 0.8%, and we would have made 7%. So as you can see, the losses that when they incur, even when this market, say like this is how allows me to have a fluid motion. I never use stop losses personally. That's going to cause a lot of people watching this video to go, but I don't. But what I do is, because I position myself correctly, this market here, my stop loss would have been just underneath this low. Obviously, I'm not going to go into my system right now. We'll do this in another video, but my stop loss would have been there. So when the market come down, we would only been down 0.09% of the account. Then when it dropped, at its absolute peak, we would have been down 1.26%, which is on a £100,000 account, $1,260. Then when we come back up, and I saw that we were coming close to our range, it's just enough to get out without, having too much stress. I don't have to worry about it coming right the way back up to get the perfect amount, because all I'll be losing is 0.31%, which is $310 on the position. It allows you to not have this psychological weight above you because you are not scaled in incorrectly. Your risk tolerance is acceptable and you are scaled in correctly. So as we can see, within inside of this month, at risking 1% of our account, we would have made 7%, and we would have had a maximum drawdown of less than 1%. And we had some large losses. I mean, even if you got in really late on this market and it pushed all the way up and it come all the way back down, and your stop loss was supposed to be here on top of this high, so we doubled, tripled our stop loss, you would have only been down $850, 0.85%. So it's very easy then to not be stressed when it comes to it. Now, I know a lot of people will be thinking watching this video, 7%, well, that's ridiculous. I could go and earn more. Well, you probably could, because the people that you're watching and the gurus, they are positioning themselves within inside of this market incorrectly. A 7% gain on a £100,000 account, $100,000 account, is $7,000. So as we can see, our maximum drawdown was less than 1%, and on a most proprietary trading firms, you're allowed up to 10%. So we know, say we rounded that to 1%, we could times that by 2 or by 3. So say we just did it by 2, we would be up 14% with a maximum drawdown of 1.6%. Do you see how immediately this is so much easier? And that is enough to pass any. So once you pass the prop firm with the heightened risk, you can either change your risk allowance or not. This month on a 100 grand account would have made you $14,000 within 1 month. Now I do have my other chart, which is already linked out, where I have my monthly statistics. I am currently in a position right now to sell. I've got in this sell yesterday, and my stop loss is just above this head high, and the market has obviously pushed it. I don't use stop losses. It's simple as that. I don't use stop losses. If this market was to boom all the way up, I would simply wait for it to retrace, see a little bit of like wick or somewhere that makes sense, and I would just get out. I'm not obligated and don't feel this feeling of weight above me to get out, because the positions themselves are not huge. So as we can see here, we lost 0.14%, 0.35%, 0.29%, 0.23%. So on a $100,000 account, I would have lost 140, 350, 290, 230. And that is a lot different than if I was risking 1% and being £1,000 each trade. That would have been £1,000 loss, 2,000, 3,000, 4,000. That would have been absolutely abysmal on my psychological side of my trading. It would have been horrendous. And as we can see, I always detail down. I put my balance drawdown and my absolute drawdowns. My balance drawdown is the start of the month, how much my account went into negative. And the absolute drawdown is how much in a row would have lost. So February made 6.33% because we had these losses come in here. Oh, just moved my thing out of the way. And we're currently in an open position now. So we have made so far this month 6.33%. Our balance drawdown was 0%, and my absolute drawdown was 1.01%. So $1,000 to make 6,300. The prior month, we can see we made 6.59%, so $6,590. Our balance drawdown was 0, and our absolute drawdown was 1.78%. So in this case, $1,780. The month before that, in December, we can see that I had made 7.08%. That is $7,080. My absolute balance drawdown was $340. My absolute drawdown was $930. Month before, we had a bad month in November, mainly because we were continuing on trades. I had to delete them because if you do use TradingView, you would understand that all of these added up starts getting laggy. But we had a position that was just continuously being carried over, and I never count the close as being within that month. I count it for the prior month. But as we can see here, we didn't make that much. We made 3.88% with a balance drawdown of 0.15 and an absolute drawdown of 0.62. So that would have been $3,888 in the bank, and $150 being the maximum drawdown, with an absolute drawdown of $620. So with a 100,000 account, you can see very quickly that I could have made 10%, 20%, could have made these 20, 30%. However, for me, longevity is the game, and I'm not in there to have a high risk tolerance. I've done this before, and I used to be a 1 minute and 5 minute trader, and it's just not for me. However, I'm getting off topic. This is how you should correctly position yourself within inside of the market, is using the positions of the market to risk 1% of your account per 1% market move. So again, just to go over it again, we're going to use a price. We're going to measure out for 1%. You're going to use a horizontal ray, and you are going to place them. You're to copy the coordinates, place them into a profit calculator, and it is as simple as that. You can also do this on anything. I mean, if we went to go to, I don't know, gold. So if we go over to here, and we can go to gold, and we were to then use the price tool, and we went all the way down to 1% move, and we placed on either side. We could then double click, copy in the open price, paste, double click, copy in the close price, paste. We could then calculate, and we can see that's 20. That's 20. So if we were to use, again, we're running to risk 1% of our account on 100,000. That is £1,000. So say we were to then, so we can see that probably 48 would do. 49 maybe. That will do for me. So on gold, we would be using a 49 lots to risk 1%. And as you can see, if you were to have, I don't know, a position, say you were to trend trade, and at the moment you're learning, and you were to get in on the bottom of this supply, and say we've got in here just to give ourselves a loss, and you want to keep it nice and tight, and you were targeting the top high for 4%, for 1 to 4, you would have lost $160, and that's because it's at 0.16. However, you would have been looking to make 0.64%, which would have been $640. If you had got in down here, and I don't know, you got all the way up here, you can then see that down here you'd have been risking $260, and you would have made $1,111. Now, this adds up. People try to pass prop firms and think of 10%, 20% a month as in getting in max trades. So getting in right here for a buy, or right here for a sell, or right here for a buy, and right here for a sell, and catch these big swing moves. Now, they're unrealistic. It's never really going to happen. Your time in the market, you're going to be wrong 90% of the time. However, if you were to want to get in here and you took that short down here and you didn't use a solid stop loss, and even if you placed it all the way above, you'd still be risking, with all this distance, less than 1%, just over 0.5%. So if you were to say, okay, well, I know I want to get in here, and my stop loss, I want to be here, you can draw that stop loss through, and when the market comes in, you don't have this overwhelming need to rush to close the position. And the reason is because, again, the difference would be from 0.15%, so $150, to 0.34%, so $340. On a $100,000 account, where you have a maximum daily drawdown of $5,000, it's nothing. You really, really do not care. So you can then wait to see if the pop actually is a pop, or if it's a fake out, and to see if it comes back down. 90% of the time, these pops will return back down if it happens in the Asian session with inside the London session. Always happens. And if you were to hold on for that, and you said, well, okay, then we'll get down here, and we saw that market move, you're not in too much of a grab to take all your money, because as you can see here, you'd only be up 1.87%, which is $1,870, $1,870. So if it did come all the way up, and we closed out above this top high, and even if you wanted to get out a little bit higher, and you got out over here after you waited to see if that was an actual confirmed break of your high, you would have made that out with 1.22%. That would have been $1,220. And that was in 3 days, or 4 days if you want to count that. But over the month, that adds up. Remember, traders, you are playing the long game. You are not playing the short, let's quickly make a load of money game. You're in there for the long game. You want to keep these accounts if you do pass these accounts. You can then build your risk tolerance off of these percentages, and that would be the correct unit trade lot size that you should be going in with. I hope that you all found that understandable, and I didn't speak too fast. I'm not, I'm not some influencer guru that's out there. I am a trader that trades for a living, so I do apologize if the format is a little bit, unprofessional, and it hasn't got all the big flashy, hey guys, up in your face. It's just, unfortunately, it's not me as a character. and I wouldn't really have the energy to do so anyway. But I hope that you found it informative and that something clicked within there and you thought, okay, actually that makes sense, because if I was to invest and I wanted to invest into an account, and I had my a day trading account, and then I had an investment account. On that investment account, what would matter is the percentage gain on your overall account. If you had $10,000 or £10,000 within that account, you're going to see, oh, well, hang on, it's been a month and I've made 15%. And you'll be happy with that 15%. You know, £1,500 on in 1 month or 2 months on your £10,000 would be good, because you know, like, oh, okay, this is steady. And every time that people invest, they don't feel as scared or stressed about their money as they do when they day trade or just trade overall, trading leverage. And that's because they leverage their positions wrongly. What leverage really truly allows you to do is, as I just said there, is finding out your risk tolerances. I mean, right here, this was where my stop loss was. We come straight back up and come down because I don't use a hard stop loss. This might break and close up here, and I'll wait for it to come to close back out. But as you can see, I don't use, the traditional, how everyone else trades their lot sizes is 1% per trade on their stop loss and all this crap, because I don't need to. I just focus on the percentage gain and grind it out. I mean, if you had an investment account and you put, you know, £10,000 into it and you saw these returns within a month, this is over like 20 odd percent within 1 month, you'd be very, very chuffed, because it's good money that you're earning and it's steady, and you don't feel like you're going to go to zero on your account. You don't feel like you're going to lose that £10,000. But we all know that if inside of day trading, with the average traditional way that is taught out there on YouTube and Reddit and things like that, it is very, very high chance that you will lose that whole £10,000. And that's because you are positioned in incorrectly. So I just hope that you have found something informative out of here. If you have, leave a like or a comment. You can say, what you don't understand, and I'll build another one. I'll do another video. I mean, I'll try to keep them shorter. We're at 22 minutes right now. Like I say, again, I'm not a guru. I'm not this influencer kind of person. That's why I haven't got all the big cameras on. But yeah, I just wanted to bring something to the table, and teach people that, you know, want to understand trading and they want to get into it, but how you should be trading. You know, people would put an investment on and they would leave it. You don't see someone put investments in stocks and they're checking their stocks every couple of minutes or every 5 hours. They don't do it. They place them and they'll check them tomorrow. They'll check them the next day, because they're not worried, because they know that they're not going to check and put £10,000 on and check tomorrow and see that they're £5,000 down. They know that's not going to happen, or they're not going to go on and check like, oh wow, I'm £2,000 down in my account, or I'm £1,000 down in my account, because these platforms position you correctly. So I hope that you found something interesting about it, or it helped. And like I say, just a bit of if you want to have a bit of community or a little bit of contact, just message down below. Um, yeah, and if you want something to be shown, maybe it's the system that I trade with, I'll build another video. Yeah, it's not a problem for me at all. But yeah, happy trading, guys, and I hope that this found you well. Thanks.